Chapter 15 of The Intelligent Investor by Benjamin Graham, titled Stock Selection for the Defensive Investor, presents a clear and methodical approach to stock selection for investors who prioritize safety and stability over high returns. Unlike enterprising investors, defensive investors are conservative by nature, seeking investments that offer consistent, reliable returns while minimizing risk. This chapter focuses on helping such investors build a portfolio that can withstand economic uncertainty while offering modest but steady long-term growth. Graham's guidance in this chapter revolves around the concept of avoiding speculative investments and instead concentrating on companies with solid financial foundations. These are large, well-established firms that have demonstrated stable earnings and dividend payments over time. The chapter is essential reading for individuals who prefer a hands-off approach to investing, while still wanting to protect their capital from the volatility and risks inherent in the stock market. The defensive investor's mindset. The defensive investor's primary objective is to preserve capital while generating a reasonable rate of return. This approach contrasts with that of the enterprising investor, who is willing to invest more time and effort in identifying high-growth opportunities and managing risks. Graham argues that while both strategies can be effective, they require vastly different temperaments and commitment levels. Defensive investors typically lack the time or inclination to perform the extensive research required by more aggressive investment strategies. For them, a stable, well-diversified portfolio that requires minimal intervention is ideal. Graham insists that the defensive investor should adopt a long-term perspective, focusing on the overall safety and stability of their portfolio rather than chasing short-term profits. This mindset is about avoiding losses and steadily growing capital, even if it means missing out on speculative opportunities with higher potential returns. Criteria for selecting stocks. In Chapter 15, Graham lays out specific criteria for defensive investors when choosing stocks, emphasizing conservatism, stability, and financial health. These guidelines help ensure that investments align with the defensive investor's objective of building a low-risk portfolio. Size of the company favor. Large and well-established companies. Graham advocates for defensive investors to focus on large companies with a proven track record. These companies are typically market leaders with strong financial backing, which helps them survive economic downturns. Large firms tend to have more diversified revenue streams, reducing the impact of industry-specific challenges on their overall performance. A key benefit of investing in large companies is that they tend to have more predictable earnings and dividends, making them lower-risk investments. Such companies also tend to be more transparent with their financials, offering a clear view of their financial health and stability. Strong financial position, low debt, and strong balance sheets. A company's financial position is crucial for defensive investors. Graham advises focusing on firms with low levels of debt relative to their equity. Low debt reduces the risk of bankruptcy or financial distress during economic slowdowns, as these companies can cover their obligations even when cash flows are tight. The current ratio, which measures a company's ability to pay off its short-term liabilities with short-term assets, should also be examined. A ratio of at least 2-to-1 is preferred, indicating that the company has enough liquid assets to cover its short-term liabilities comfortably. Defensive investors should avoid companies with high levels of debt or those in cyclical industries that experience wide fluctuations in earnings. Such companies are more vulnerable to market downturns and can lead to losses for conservative investors. Earnings. Stability. Consistent profits over the long term. One of the most important factors for the defensive investor is earnings stability. Graham recommends selecting companies that have demonstrated a history of positive earnings over the past decade. Consistent earnings show that the company's business model is robust and that it can generate profits regardless of market conditions. Earning stability is critical for ensuring that the company will continue to pay dividends, which are a vital component of the defensive investor's income. Graham suggests avoiding companies with erratic earnings, as this signals potential instability in their business. Dividend record, regular and reliable dividend payments. Dividend payments are essential for defensive investors, providing a steady income stream that helps offset the risks of stock price volatility. Graham recommends choosing companies with a long history of regular dividend payments, preferably over several decades. Firms that pay consistent dividends demonstrate financial strength and a commitment to returning value to shareholders. Dividends also act as a buffer during market downturns, as they provide a source of income even when stock prices decline. Companies that cut their dividends are often seen as having financial trouble, which can negatively affect their stock price. As such, defensive investors should focus on companies with a reliable dividend track record and a payout ratio that suggests the dividend is sustainable. Moderate price-to-earnings, or PE, ratio, avoid overpaying for stocks. Graham advises defensive investors to avoid stocks with excessively high price-to-earnings, PE ratios, as these may indicate that the stock is overvalued based on speculative growth expectations. Instead, defensive investors should focus on stocks with moderate PE ratios, indicating that the stock is fairly valued based on its earnings. A stock with a high PE ratio is typically priced for growth, meaning that investors expect future earnings to rise significantly. However, this can be risky, as any failure to meet these expectations can result in a sharp decline in the stock price. Defensive investors should focus on companies with a reasonable PE ratio, suggesting that the market is not overestimating the company's growth potential. Moderate price-to-book, PB ratio. Buy stocks below their book value. Another key valuation metric is the price-to-book PB ratio, which compares a company's stock price to its net asset value or book value. Graham recommends that defensive investors favor companies with a PB ratio of less than 1.5. This suggests that the stock is trading below its net asset value, meaning the investor is buying the company's assets at a discount. By focusing on companies with low PB ratios, defensive investors reduce the risk of overpaying for stocks and increase their potential for gains if the market corrects the mispricing. Diversification, spreading risk across multiple investments. One of the central tenets of defensive investing is diversification, spreading investments across various sectors, industries and companies to reduce the impact of poor performance by any single investment. Graham suggests that defensive investors build a well-diversified portfolio of 10 to 30 stocks. This diversification helps mitigate the risk of significant losses, as the decline in one stock or sector is likely to be offset by gains in others. Diversification also allows defensive investors to smooth out the volatility in their portfolio, as the performance of different sectors tends to be less correlated. For example, during a market downturn, defensive sectors like utilities or consumer staples may perform better than cyclical sectors like technology or consumer discretionary, helping to protect the portfolio from large losses. Avoiding high-growth and speculative stocks. Graham strongly advises defensive investors to avoid high-growth or speculative stocks. These stocks, often found in industries like technology or biotechnology, may offer the potential for significant gains, but they also carry higher risk. Growth stocks tend to have high price-to-earnings ratios, driven by optimistic expectations of future earnings. If these companies fail to meet those expectations, their stock prices can decline rapidly, leading to significant losses. Instead of chasing high-growth stocks, Graham recommends focusing on stable, established companies that are less vulnerable to market volatility. These companies may not offer the same explosive growth potential as speculative stocks, but they provide a more reliable path to long-term wealth accumulation. The importance of patience and discipline. Graham stresses that patience and discipline are crucial for defensive investors. By following a systematic approach to stock selection and avoiding speculative investments, defensive investors can achieve steady returns over time. Graham reminds investors that the stock market is inherently volatile and there will be periods when prices fluctuate dramatically. However, by focusing on companies with strong financials and holding onto them for the long term, defensive investors can weather these fluctuations and achieve their financial goals. Conclusion. Chapter 15 of The Intelligent Investor offers a comprehensive strategy for stock selection that emphasizes safety, stability, and long-term growth. For defensive investors, the key is to focus on large, well-established companies with strong financials, consistent earnings, and a history of paying dividends. Graham's advice to avoid speculative or high-growth stocks, combined with a disciplined approach to valuation and diversification, provides a solid foundation for building a portfolio that can withstand economic uncertainty while delivering steady returns. In essence, defensive investing is about minimizing risk while ensuring a modest but reliable return on investment. By following Graham's guidelines, defensive investors can protect their capital and grow their wealth over time without being overly exposed to the inherent risks and volatility of the stock market.
Thank you for watching. Share this with friends and family, and please subscribe.